All right, so I'm going to continue where we left off last class. Namely, we had already covered, hopefully, a little bit on some of the metrics that we'll be using throughout this course and in other courses. And I'm now going to continue on to a conversation on markets and their essential characteristics. Some of this will be repetitive for some of you, which is, I think, fine. If you know it, then you can skip through this relatively quickly. For many of you, it might be the case that you can probably just listen to this in the background while you're doing something else. I don't think there's anything too advanced for the next few slides. But if you are a little bit rusty, we want to make sure that you cover all the things in great detail. You also want to be careful that although things may start slow, eventually they will begin to accelerate, and you don't want to get caught behind on that. So in terms of the essential review, from 308, you should have seen a conversation at some point about financial securities. So if we imagine, a very simple case, we have a factory which is producing widgets or something like this. The way that this factory, the operators, the owners will receive capital to be able to build this factory is they will issue financial securities to the market. And in return, investors will send back capital in the form of cash. And so what will happen in a normal operation is that as the factory produces a product, the factory will sell the product and then generate cash flows from that product. Those cash flows can then be used by the managing firm, by the manager, to return capital to the investor. Or alternatively, it might be used to finance the growth of the factory, and you might build a bigger factory to produce more widgets, and therefore the company gains value in this way. Okay. There are a different variety of financial securities. There are stocks, obviously. This is probably the one that you're most familiar with. It's the one that we discuss in great detail, or what we could also call as equities. But then there's also bonds, of course. And so how do they differ? Bonds will traditionally have fixed payments to be made. That makes it risky for the corporation to get capital in financed by bonds. The reason being is that as they operate, they have to make a fixed payment at a set schedule. If for some reason in a given month, let's say you could imagine what's happening right now for a lot of firms in the COVID situation is their revenues drop, and they could have a difficulty returning the cash flows or the promised cash flows, the coupon payments to the investors. As a result, the investors could get quite upset. First off, they might react by selling the financial security in the secondary market. That would mean selling the bond to someone else. But they could also seek legal recourse. They could attempt to force the firm to give cash flows, if that even meant selling the factory, for sale on the factory, for example. So you might force the management team to liquidate assets to be able to make repayment on the fixed payments that are promised. Equities or stocks, in contrast, they are given a dividend flow. So in the form of dividends, that's optional in most cases. In the case of preferred equities, it can be the case that there is a dividend flow that's assured, but it doesn't necessarily mean it's assured at a specific time. So you'd have an accrual of dividends that have to be paid at a certain time or another, but they don't necessarily need to be paid immediately. And so equities, either by completely deferring, either deferring dividends or completely annulling them for a period of time, that allows a company to stay in operations even when revenue drops. It's not the purview of this course, so I won't go too deep into it, but in Fina 395, you should have an extended conversation. Why would anyone choose to have debt financing if it's risky? If debt can lead to an insolvency, that is, lead to a situation where you don't have the capital to pay the fixed coupons. Why would anyone choose debt financing? And a couple of answers could be either ease, or the traditional one that you see in the M&M theory is there's a tax shield associated with debt. Debt, you can use the coupon payments on debt as a pre-tax reduction to your income for the purposes of taxation, whereas when you pay dividends, you pay out of after-tax dollars. So in a sense, debt is tax subsidized or tax advantaged as compared to equity. Okay, so there's a higher risk using debt as part of your capital structure, but the benefit is that there's a bit of a tax shield. Now, having discussed the various securities that you're going to see, we're also going to talk about derivatives a little bit in this course. I won't go into great depth right now, but what I will say is that a derivative is a financial security that draws its value from something more fundamental. So, for example, you might have the option to purchase a financial security. You might have the option to buy stock, for example. That effectively means that the derivative derives its value from something more fundamental. In this case, I'm giving an example of an option on equity, although you can have options on debt, such as the collateral default swaps. And so options on other more primitive financial securities, there's a large amount that we will be discussing, but we won't be getting there just yet. So I'll defer that for a moment. In terms of exchange markets, so how do investors actually exchange? You know, that little diagram that I kind of messily drew. How is it that people actually get capital into the firm? So if I'm going to go back to the case of I have my entrepreneur or my manager who's looking to raise capital, they're going to issue securities. The way this is traditionally done is you are assisted by an IB, an investment bank, which will facilitate your offering of securities into an exchange. Examples of exchanges could include the New York Stock Exchange, which is probably the most famous one, but there's also the TSX, the Toronto Stock Exchange. There's the NASDAQ, which is another American exchange. There's the Amex, CAC, all in France. So there's many different exchanges that you can consider. And so you would approach an investment bank and they would help issue your securities to one or perhaps many of these exchanges. If you are available on more than one exchange, for example, Royal Bank is available both on the New York Stock Exchange and on the TSX. This is what we call a cross-listed security. That is, there's an availability of it on two locations. But most securities don't fall under that category. Most securities will allocate themselves or be available on one exchange or another. So most blue chip stocks we would think would be on the NYSE, and many technology stocks might be on the NASDAQ. And in Canada, the big Canadian companies that you'd think of are big banks like Royal Bank, or they'd be on the TSX. Okay, so in an exchange market, you can have basically a situation that your entrepreneur, your original owner, has decided that they're going to try and to issue securities on the market with the assistance of an investment bank into one of these exchanges. Once those securities are issued into that market, investors would be purchasing them through that exchange. So effectively, capital flows through the exchange, and with a small charge only initially, the investment bank will take a small spread. The capital will flow to the entrepreneur, which will enable the entrepreneur to go ahead and buy their first factory or whatever. If this is the first time that they're doing this, this is what we call an IPO, an initial public offering, which is the case where an entrepreneur for the first time goes to the public to offer their securities. If this is sometimes you, as the business is operating, you've built your first factory, things are going well, but maybe demand is higher than anticipated, and so you need to build a second factory very quickly to be able to meet that sudden demand that you hadn't realized how popular your product was. You might need to tap the market a second time. If you go back, this is what we call an SEO, or seasoned equity offering. So a corporation that already exists, that's already exchange listed, might do an SEO to get more capital to be able to continue their expansion. Okay. Now, once the securities are in the exchange, investors, I'm just going to tidy up my board here a little bit. Investors have the facility or the capability to trade amongst each other. This is what we call trading in the secondary market. So what I have just described moments ago is what we call the primary market in financial terminology. The primary market being when you first issue a security. If you are in the secondary markets, then this is a situation where your entrepreneur, I'll just pencil him in here again, he's got his money that he had to build the factory, operate the factory. You now have a situation where you have different investors who are able to trade together on the exchange. So you can imagine that there's this little location. Physically, it used to be a physical location. Now it's more a digital space. But for example, in New York Stock Exchange, you might have an investor who has arrived, who has some money in his hand, and someone else who has a stock certificate in their hand, and they are able to trade. This individual can surrender their stock certificate, and this individual would give them money to do so. And when we talk about stocks gaining or losing value, what we're effectively saying is that the buyer is now willing, the buyer who most recently purchased a share is willing to pay more money to acquire a share than the previous buyer had. If people are not happy with the security, if they're not happy with the performance of the company, if this individual who's operating the firm, the entrepreneur, the manager, is not doing a good job, if the factory catches on fire and is exploding, for example, then obviously investors would be concerned about that. And so a prospective buyer, how much would they offer to the seller? The answer is not very much. We would see a situation where they don't offer very much money for those shares because they can observe, they can look at the situation over here and see that the company is in bad shape. And so prospective investors obviously will be looking at information about the operation of the firm because they're now bearing the risk that the continued firm performs well. Okay. Exchange markets can be distinguished from OTC, or what we call over-the-counter markets, in the sense that you have a singular location. I've kind of drawn this very crudely, but we have something like the New York Stock Exchange, and you have a series of individuals who are trading within that space. Traditionally, if you go back and you look at actually open cry markets, the pits, it was the case that you'd actually have a single location where people would trade, but that's not been the case for for quite many years now, almost a couple of decades at this point. So practically speaking, what's happening now is it's a situation of computers, but you can imagine that in New York or in the geographic location around New York, so here for New York, let's be a little bit more precise, we'll be somewhere inside Manhattan. The New York Stock Exchange will actually be a series of computers that are not too distant from each other. There are some that are over inside New Jersey, actually, for both taxation reasons and technical support reasons. So you'd have a few machines that are in New Jersey, a few that are in New York, and they're interconnected to each other. And this network of machines is effectively the New York Stock Exchange. So when we talk about trading, what's happening is you on your little personal computer at home, I know I'm drawing a very antiquated looking computer, but I want to make sure it looks clear that it's a personal computer. Your personal computer would send an order to your broker, which would also be another machine in this case. So this might be TD Waterhouse, for example. You might place an order to purchase something, and then your broker would have access to this network on your behalf, would issue a request to purchase your shares, would take money from your account and would promise it to someone else on the other inside this network, who would themselves have their own broker that is connecting them to this network. And so what would happen is effectively there would be an electronic wire transfer of your capital through the network to this individual, and an agreement within the exchange servers that the share that was originally identified as being within broker A, that share is now being possessed by broker B, and broker B would ensure that that actual share is assigned to your personal account. Okay, so this is how things actually work in an exchange system. Now, you can have a different architecture, you can have a different structure. If we talk about over-the-counter markets, what you could have is you could have a situation where we have many, this is, again, I'm sort of showing it as an antiquated system, but you can imagine having many different computers that are all independent in some sense. These would probably still be brokers or what we'd call contacts, but they would still have they'd have their own system. And so you as an individual, let's say this is, your computer, you could put a request out to the one who's closest to you and say, do you have shares? You have shares. And if that machine does not have any shares, it could route your order to other connections it has in its own network. And so what would happen is your requests could be kind of propagate through a network of many. I'm just going to simplify them by putting boxes, but you might have many connections that exist, interconnections that exist between various machines. And so maybe it comes here and it says, I don't have any shares for you, nor does this person, but they know someone who does. And so what could happen is you could route your order through here and the share transfer could occur this way. And so this is what we call an over-the-counter market. There's no sort of centralized physical location where this occurs. Practically speaking, nowadays, because of the sophistication of computers, the operations of these markets look largely the same. But historically speaking, if these pictures had not been of not have been of computers, but have been of people, you could imagine that you would basically say, hey, Bob, do you have some tickets to the show for me? If this is Bob, let's say. And Bob says, no, I don't, but I know someone who might know someone. I'll call Sally, and she's very connected. Maybe she knows Frank at the other end. And maybe Frank has some tickets that I can get you for the show that you want to go to. So you'd give your money indirectly to Bob, or you make a promissory note through Bob to get you a connection to Frank, who would be providing the, in this case, product or service that you're interested in. Okay, and so this network can be a little bit slower. What you effectively want to do is you want to be connected to someone who themselves is very interconnected. If Bob is a nexus that has many, many connections to different other people in the OTC, then he is a valuable connection and you'd like to connect with him because he has a higher likelihood of being able to fill your order quickly and cheaply. Okay. I seem to be having a problem returning to my slide. All right, so that covers a little bit on the OTC markets. There are players in this space as well, which we call market intermediaries and financial intermediaries. So when we make these trades, there's a couple of ways that you can do things, of course. So if you imagine, we'll just stay in the exchange traded situation. So let's not worry about OTC right now. We have an exchange. Let's say we have an issuing company. They're issuing new debt, for example, new bonds or something like that. So let's make it a mortgage company. Why not? So we'll have a mortgage investor, mortgage investment company. So their business model is they take capital that they get from the markets and they go and they put it into the mortgage market. Investment firm, and here you are as an investor. Okay, and so when you have, for example, between you and the exchange, you have a broker. So when you go through a broker to purchase a security from the mortgage, we would call this kind of firm a market intermediary. What they are doing is they're intermediate between you. They're standing in between you and the actual market, and they will help you. They will help facilitate your access and your ability to get the shares, or in this case, the units of the mortgage-backed security that you want, and would basically act as a conduit to help get the capital to the issuer of those securities. Okay. There can be cases, however, that there's an intermediary on the other end here, though. Okay, so here we could have, for example, a financial intermediary. A financial intermediary is doing something to the underlying product. Okay, so when you talk about a market intermediary, you might imagine this as something, if you want to sort of think of an analog, you could think of this as being something like a real estate agent in the housing market. Okay, I'm going to switch here from mortgage-backed securities. Let's just talk about houses. Okay, and in this case, who's your broker? You have a real estate broker. And let's not worry about the investment firm for a second. Maybe we'll start with a fresh diagram, make things tidier. So here we have a house. We have a potential seller. And we have a potential buyer. And we have a real estate agent that stands in the middle, or possibly even two. In most deals, there's two real estate agents. But in this case, let's just have the single real estate agent. They're going to be both the listing and buying agent. And so what will happen is the real estate agent will help bring these guys together so that basically the deed ownership of the house is being transferred from the seller to the buyer, and the capital from the buyer is being transferred to the seller. Okay, and so as such, this is just a market intermediary. They've done nothing to the underlying product. Okay, but what if, for example, this was not just a real estate agent, but this was also a flipper, a person who buys buildings and modifies them in some sense. So instead of this arrangement, what they might do is they might buy this building and subdivide it and do some construction on it, put in 2 new doors, change the windows. So in this case, initially we do not have a buyer here to begin with. What we have is we have this flipping land developer who purchases the building for themselves, and what they intend to do is they intend to purchase it, subdivide the units, and then once they've done so, they might find numerous buyers who would buy the subunits. Okay, so here we have a situation where the money is going in, and the original deed has in effect, they'd file with the city and they'd sort of split this into 2 deeds if they could, split the lot if they're able. If not, they'd create some kind of shell corporation that would handle ownership or something like this. If you think about like a condo unit, there's a strata association. So what will happen is they will find a way of subdividing ownership rights or legal responsibilities, and they will surrender those to the individuals. And the individuals would surrender their money. So the flipper has done something in this case. They've modified the underlying product. Originally we had a single house, a single occupancy dwelling. Now we have a multi-occupant dwelling. And so what they have done is they've modified the underlying product. This would be akin to a financial intermediary. Okay, so going back to our example here, if we have, let's say, a financial intermediary here, the classic ones we might think about would be investment banks. Investment banks might, let's say, buy many bonds or stocks from the market. Bonds, stocks. They could mix these in a certain way, and then they might sell off claims to different individuals. Different kinds of investors might want to buy a different mixture of this portfolio of different securities. And so they kind of are modifying or mixing or changing the underlying products. They're not just selling you a virgin bond. So in a sense, a broker would not normally do this operation. A broker would simply say, okay, Dave, you want to buy a share in IBM? Here's a share in IBM. An investment bank say, would you like to buy just the dividend stream of IBM? That is, if the stock gains in value, someone else will be the beneficiary of that, but you will have access to the dividend stream and only the dividend stream. And so I would need an investment bank or a financial intermediary to provide that kind of product. Okay. All right. So this gives us a little bit of a primer on market intermediaries and financial intermediaries. A little bit more on the sort of the essential review to consider. So when a financial security trades, there's a transaction fee. So when we actually go through your broker, they will take a tiny bit of the money. It's quite reasonable these days as to how much they take, but they will take a small charge. Often it's a flat fee to initiate the transaction, and then a small amount per security that's traded. So there'd be a transaction fee. The other thing to consider is what we call bid and asks. Okay, so hopefully you've seen this in COM 220. If you haven't, I'm going to zoom in a little bit here. I've got a little bit of a review to sort of go over what we call the order book. And so I'm skipping a little bit on, I know I'll have to back up a slide in a moment, but I'll go ahead here. And so here we have a situation where there are buyers, prospective buyers, and prospective sellers of a company. Okay, so this is what I'm going to call is the initial arrangement in the market. So what we have here is a series of prices, and then we have a series of demand, bidders, prospective buyers, and sellers, what they're asking for this stock that we're looking at. So for example, at the price of $11, there is an available supply of 5 shares by sellers. At the price of $10.50, there's an available supply of 7 shares. At the price of $10.25, there's an available supply of 5 shares. You'll notice that below, at $10 and below, there's no supply. That is, none of the sellers who possess the shares are willing to accept a price of $10 or less. The present sellers do not feel that the shares are worth so little as that. They're willing to sell, but only if they get a price better than $10.25. In contrast, if you look at the buyers, you'll notice that there's a demand at $7, although there's no suppliers at that price. There's demand at $9.50. But eventually, you find that there's no buyers above a certain threshold. In this case, it's $11. Okay, so what that effectively means is that if we ask ourselves, what will the price be? You can see initially there's a bit of an overlap. Okay, this is why I put an initial. So this is an initial setup, because what will happen is when you have an overlap between buyers and sellers, trades will occur. Okay, what will eventually happen is you should get what we call a gap or a bid-ask spread. Difference between the bids and the asks. So for example, in this situation, again, I probably made it a little bit messier than I should. Here we have a case where we have a person who's bidding $10.50. They're trying to buy a single share, which is not a huge quantity, but they are bidding the highest price. So you could imagine that whoever's organizing the market maker or whatever exchange it is, they would say, look, this person's offering the highest price. We have some people who are selling and they're willing to accept that price or lower. So why don't we let this guy exit the market? We're going to allow one share to trade at $10.50. This person's going to be quite happy because they're going to surrender their $10.50. And this individual who's only willing to provide we have a total supply of up to 12 shares at that price, but this person's willing to provide 7 shares at that at the price of $10.50 and no lower. Why don't we let them trade one of their shares? So what will happen is, in effect, this buyer will be satisfied, and the total amount of selling availability would be reduced by 1 share down to 6. Okay, and if we look at the next lower level, we'll see that here we have a supply of 5 shares and a demand of 5 shares at a set price, and so this will completely nullify each other. The 5 shares will trade, and so what would happen is you'd see that we would end up with, after a moment, there would be no supply or demand at $10.25. There still exists some supply above $10.50 or higher, at $10.50 and higher, and there's still demand at $10 and less. Here we have demand, and here we have supply, but they do not intersect. They do not cross. And so what will happen is the market will stop trading, and we will end up with a lowest asking price and a highest available bidding price, and this is what we call the bid-ask spread. Okay, so this is the difference. In this case, it's about 50 cents. And in this case, it's about 50 cents on a stock worth, and I'm going to put a little tilde here to signal around. It's around $10, right? I mean, it's fair to say exactly what the price is. Something we'll talk about why we're not certain about what the price is in a moment. But basically, it's about 50 cents on $10 stock. That's a very large, to give you a sense of scale, this is a pretty large bid-ask spread. that is suggestive of a stock that's not very liquid. You would anticipate that on a very liquid stock, let's say a Canadian banking stock or something, which tend to be very popular, traded in our market, perhaps they're commanding an $80 share price. Maybe the bid is $80 and the ask might be like $80.02. It'd be about a 2-cent difference on an $80 share price. So as a percentage, you can see it's a lot lesser. Okay, now why did I say the price of the security is not known, is a little bit imprecise? When we talk about the price of a security, what we effectively mean is what was the last traded price. A lot of people think that it's like walking to Walmart and you can just buy something for $5, that there's no haggling to be done, and that all units are priced the same way and set by the store. That's not how shares trade. How shares trade is, when we talk about a price, we're talking about what was the last observed trade. In this case, the last observed trade we occurred was at 10.25. Okay, between the bid and the ask. Most of the time, the last observed trade would be between the bid and the ask. There are cases where it could be violated for that, but most of the time you would see that. So what we have here is a situation that the last observed transaction was at 10.25, but if you wanted to be a new buyer and you said, I've got to have a share, I've got to get in there, I've got to buy something right away, you're going to pay $10.50, even though the most recent price transaction was 10.25. That is, the guy who just left the exchange paid 10.25 for his share. But you as a new buyer, if you say, I have to buy it, I don't care what the price is, I'm price insensitive, the cheapest share available by suppliers is $10.50. That's what you're going to pay. If you are a desperate seller and you say, I must sell my shares, I don't care what price I get, I must get out, the highest offer available to you is $10. So that is the highest bid, the highest price that any buyer is willing to offer you is $10. So an urgent buyer would have to pay $10.50 to get into the market. An urgent seller would have to pay $10 to get, would have to accept only $10 on their way out of the market. Okay, and so you'll notice that having a high bid-ask spread makes it kind of clunky to get in and out of the market. This is a consideration in terms of trading strategies as you get in and out. You have to consider you buy here and you sell at this. That is if the market does nothing at all. And so that creates a bit of an impedance, a bit of a pressure to make sure that if you're going to buy in, you want the stock to go the way that you're hoping it will over at least your holding period a little bit, to compensate you for, one, your brokerage fees, and two, the bid-ask spread. The other thing to consider is what happens if, for example, you have a bunch of you have a sudden urge that you must sell your shares. Okay, so what if you had to sell? What if I had to sell 21 shares, for example? Okay. Well, we can see that I can there's someone who's willing to buy the first 10 shares at $10. So fine, I'll end up selling 10 at $10. And then I can sell, I'm trying to accumulate a total number of shares, 21. So my next 10 shares, I'm going to sell at $9.50. But then my last share, I'm selling it at $7. Right? Which, if you look at it here, going from selling 10 shares, or selling, let's say, 10 shares to 11 shares, the stock price fell to $9.50. Then I was fine selling the 11th, the 12th, the 13th share. It was staying at a price of $9.50. But then as I try to sell from the 20th to the 21st share, the stock price is cratered. It's given up $2.50. What has happened is I have snapped through what we'd call a support. Okay, so a support is basically, if you look at the order book, you can see where, depending on the demand and supply, you can see that there may be rarefied areas where if you get through a certain number, then suddenly the price will move quite dramatically. Suppose I were to just change this a little bit so that I said we had 100 shares here and 100 shares here. If you think about what would happen is if someone tried to sell one share, they would get $10. If they tried to sell 10 shares, they would get still $10 each, right? If they tried to sell 50 shares in this case, they'd get $10 each. If they tried to sell 75 shares, they get $10 each. If they try to sell 99 shares, they still get $10. If they try to sell 100 shares, they still get $10. If they try to sell 101 shares, the first 100 would get $10, and the next would only get $9.50. Okay, and if we change this to make this a 1, for example, you could sell your 101st share at $9.50, and then your 102nd share would suddenly collapse to $7. So that is, you can see as the selling pressure is building, it's not a uniform, it's not a uniform price reaction. You can have a case where you're trying to sell a certain amount and the price is basically stable. This is the price here. As the volume is increasing on the sale, the price is stable. Then we get through a certain point where there's not very much demand, and suddenly the price responds very aggressively. Okay, and so what that would look like in, let's say, a little diagram of stock returns is you can see these cases where the stock's kind of going along, I won't say sideways, but kind of unremarkable, and then suddenly you have a crater. The demand just vanishes and you get through some threshold and it collapses. Technical traders will try to draw little patterns where they try to identify where these are. We will not generally be teaching you this. So technical trading is a technique to try and determine this stuff. There's also high-frequency traders that can exploit this by trying to construct an estimate of the order book using algorithms and software. So I'm not saying that this isn't profitable. What I am going to say is that for most of you at home with a personal computer, you don't have the capacity to do this. You don't have the capacity to high frequency trading. Your latency to the market is too slow. Your computers are too weak to compute the total amount of data. Your trading costs are too high to actually exercise this kind of strategy well. For technical trading, like looking at head and shoulder patterns, we'll talk about why in a market efficiency. So that is, if you believe in market efficiency, the efficient market hypothesis, which you may have seen a little bit in 308, but don't worry, we're going to discuss it a lot more. There's some serious problems. These two things don't generally go along together. That is, many professors, to varying degrees of, they'll not necessarily agree on to how much they believe these different elements, but how efficient is the market? This is sort of like a gray zone kind of conversation, but you need the market to be extraordinarily inefficient for technical trading to be profitable. And so we generally won't teach this. At least you won't see your PhD professors teaching this. You may find some people who have practitioner backgrounds that will focus on this kind of strategy a little, but I won't very much. I will talk about it a bit. I personally don't do that in my portfolio, but it is, I do acknowledge that it is a trading strategy and it can be done. Okay, so I did skip a little bit ahead. Let's back up a tiny bit because I want to cover up the last part of this slide, and then maybe I'll take a break and start fresh on the next slide. So we talked about bid and ask. We've talked about the order book. This here is the order book. This is the order book. You would love to have access to this. Why? Because you could see how prices would respond, but truth be told, what most people have access to is just this. They have access to the last traded price, they have access to the bid and the ask, and the rest is not available to them. I am going to skip back a tiny bit here, and I had intentionally skipped a concept, which is what we call the market maker. Okay, so who is a market maker? A market maker is a person who, in the traditional sense of the exchange market, would have basically been in a situation where they produce the market for a given security. So let's go back to the olden days where we had an open outcry market. So here we're in the New York Stock Exchange. You can imagine that this is actually a physical space now. and you would have an individual here, and they would have basically a little podium or something that would say that they are in charge of IBM shares. Okay, so they are the person that you come to. Sellers wanting to sell IBM have to cross the floor. Buyers wanting to buy IBM have to cross the floor, and they actually go to this individual who you'd have all your prospective buyers going there to, wave their little pieces of paper saying that they want to buy. You have your sellers saying we're willing to sell at certain prices. And this person in the middle, this would be your market maker. They are an intermediary in a sense that is facilitating the transactions. Now, the market maker has an important role, which is that if you have many buyers showing up and for some reason there are no sellers at this time, not to say that there aren't people willing to sell IBM, but maybe they went for lunch. They're just not on the floor right now. You have many buyers trying to come in and buy IBM. They're going to be frustrated that they're unable to buy IBM. The market maker would keep their own little sort of treasure trove of shares available that they can sell to these people. Okay? And they would receive in exchange, they have a little, treasure chest here, making things simple or whatever, but basically the money or the promissory value from the buyers would be put into their account, and they would surrender shares to the buyers. And they would basically complete the market in the absence of available sellers. Okay, they would complete the market by providing, what we could also say is they're providing liquidity. They are willing to sell when there's an absence of sellers. If I were to switch this and I say, okay, there's sellers that could also, they could also do that. So, let's just switch the situation where we don't have sellers available, buyers available right now. We still have sellers. And so the sellers are saying that they would like to sell their shares. The market maker would hand over cash and would receive shares in exchange. Now, this is actually initially, if you think about it, this is a pretty disadvantageous situation. Because if you have many, many sellers, okay, far more sellers, practically it's not, you'd have no buyers, you might have very few. So let's say we had one buyer and a whole bunch of sellers. What this probably tells us is that IBM is in trouble. There are many people willing to sell IBM shares, but not many people willing to buy IBM shares. This is suggestive that IBM is in trouble. And this market maker at the middle of all of it, they're buying at a time when IBM's in trouble, which is not a very good time to be buying. I mean, this guy might be buying too for his own personal reasons. Maybe he thinks these guys are being irrational or ridiculous. Maybe this is Warren Buffett over here who thinks everyone else is being panicky. But for the market maker, he's buying for liquidity purposes, not because of investment purposes. He's just trying to keep the market operating. And he's therefore got to buy when there's a lot of selling demand. And conversely, if there had been a lot of buyers in the previous example I had given, if there had been a lot of buyers now trying to scoop up the shares, in this case, IBM's not in trouble. IBM's doing well. Yeah, this would explain why we have so many buyers trying to buy the shares. Now, in this situation, he's now got to sell to them. So he's selling at a time when people are excited by the stock, and he's buying when people are scared of the stock, assuming that people collectively are not idiots, then that's a really disadvantageous position to be in. So why would he ever agree to it? And the answer is, as the market is trading in a normal situation where we have a balanced market of buyers and sellers, which is generally what is existing in most of the time. Okay, so now we don't have a situation of excess supply or demand. It's kind of a more balanced market. What will happen is the sellers will transfer the shares here to the buyers, and as the buyers send their money to the sellers, a tiny portion of it will be collected to him as a spread. And he will use this to build up a little war chest of capital that will insulate him from times when the market is unbalanced. When there is a situation that suddenly a bunch of people vanish, he has his little war chest. And as long as he gets this right, what he's doing is he's kind of acting a bit like a shock absorber. Because what's happening is if you don't have him available and you had all these prospective buyers, and you don't have someone sitting on a pile of shares, the market maker, to be able to meet that buying demand, what would happen is the stock price would explode. Because he's in that space, he's able to sell. Okay, so why did I go through this long diversion? Because it is this individual who has the order book. He or she is the one who can see all the buying and selling demands from all the different traders or all the different brokerages. Okay, so the market maker is in a very privileged information position, but they are not trying to make money on IBM by buying and selling it at the right time. What they're trying to do is make money on IBM just as other people buy and sell it. They take a small spread. They don't really care if IBM is going to go up. They don't really care if IBM is going to go down. What they care about is that people continue to trade IBM, and as they trade IBM in an orderly way, either as the stock goes up or in an orderly fashion as the stock goes down, as long as it stays relatively balanced, they will collect a spread every time there's a trade. So they just want a lot of volume, and they don't really care which way the stock goes up. A market that they would enjoy would be one where it's just kind of bouncing sideways without too much activity at all. This is just lots of volume. If it's just bouncing around a lot, kind of in a band, this is very profitable for them because they're not really encountering any situations with an unbalanced market. They're not being forced to buy or sell at the wrong time. Okay, so the order book is this information, and it's great if you have access to it, but practically speaking, the only people that have access to it would be members of the exchange who are actually market makers, which is an expensive position to hold. And then when you do have it, you don't use that to make money on a stock. You use that to basically facilitate the transactions of the stock. Okay, so your function is not exactly the same as a traditional investor in that sense. Okay, so I think we've covered order book. The other thing I want to talk about is illiquid securities. So illiquid securities are ones where there isn't a lot of trading occurring, or it's very difficult to trade. Symptoms of a security being illiquid would be a wide bid-ask spread. As I established here, a 50-cent difference on a stock that's roughly $10. That's a pretty notable amount. You're looking at almost a 5% bid-ask spread over the price. So it's pretty expensive to get in and out. We would describe this as being an illiquid security. Again, a liquid security would be one where the bid-ask spread, is well below 1%. Of the price level. And a blue chip stock, this is a qualifier that we use to identify stocks. These are basically securities. Blue chip is kind of referring, I guess, to poker or something. It's just sort of referring to high quality stocks. So we would traditionally have put in there companies like IBM or GE. These were traditional blue chips. One might argue that they're not as stable. Their business model may not, IBM's still okay, but GE is clearly having a rough patch right now. So who would be our new blue chips? I guess you might consider companies like Procter & Gamble. It's not super exciting, but it is very reliable. We could probably consider Apple as being a blue chip, although it is a tech company. You could probably still call it a blue chip. It's not going anywhere anytime soon. So these would be examples, big banks, for example, Royal Bank in Canada, for example, we'd consider a blue chip stock. Okay, so what would not be blue chip? Highly speculative investment grade securities, companies that are unstable or uncertain. Tesla right now, I would not describe as a blue chip. It has the potential of becoming a blue chip. But at present, it's probably a little bit still early to say that we're, especially in the COVID situation, how will they perform over the next few months or years? That's not yet entirely determined. So I'd say they are a tech company. They are an interesting company, but I would not really describe them as a blue chip just yet. Okay, so we have orders, which I'll describe briefly, and then I'll stop this lecture for the time being, and we'll resume afterwards. So orders. When you make a transaction in the marketplace, there are a couple of different orders that you can execute. So the most obvious one is called a market order, which says I want to buy or I want to sell, and it's at the price that's available. So for example, if I issue let's look at the order book up here. If I issue a market order to buy 20 shares. Okay, I have to buy 20 shares. So what's going to happen? We've established that if we look at this order book, I would see available, I would anticipate that I can get 10 shares at $10. This I would have seen myself as an investor. The next 10 shares, the market maker would realize what I'm going to pay. I might not pay myself, but my broker has been authorized by me choosing a market order. I said, just get me, sorry, I've got this backwards. I'm trying to buy, so I should be looking at ask, not sell. So I'm gonna switch this to a sell just to make things easier. I apologize for that. So here I have a situation where I'm trying to sell 20 shares. So I'm going to successfully sell 10 shares at $10, and then the next 10 shares we saw before, I'm going to sell at $9.50, and the market maker would have a sense of that. I might be able to sort of forecast that, but I wouldn't know that with the same certainty that the market maker would. And so if you think about what my average execution price is, I sold 10 at $10, 10 at $9.50. My average execution price of a market order is $9.75. Okay, so when I issued this, I said, look, just sell 20 shares and get me out at whatever you can. My broker executes that trade, and he reports or she reports back to me, Dave, I got you out at a price of $9.75 per share for your 20 shares on average. Okay, so what would happen if I said, what if I would like to limit the order? That is, sell my shares, but only if you can get me at least, instead of doing a market order, I might say issue order to sell 20 shares at a price greater than $9.80. That is, I want to sell the shares, but only if I get a price of at least $9.80. Okay? My broker will attempt to execute that. But they will, if this is the market that they're facing, what will happen is they will successfully sell 10 shares at $10 each. This they will be able to do. But then they will find that there are no other buyers willing to pay above $9.80. And so although I asked him to sell 20 shares at above $9.80, he will come back and he will give me an incomplete order or a partly filled order. That is, he'll say, look, Dave, I managed to successfully sell 10 shares at $10, which is above the threshold that you gave me, the limit that you gave me, but I simply could not complete this entire order of 20 shares. And so you still have 10 shares in your possession, and you can either tell me to go back and sell them at whatever I can get, or you can just hang on to them yourself. Okay, so you could issue a limit order, for example. You can also have what are called stop orders. So stop orders are situations where the order is kind of dormant, but will switch on under certain conditions. So if, for example, you have a stop order, let's just tidy this, stop sell, issue a stop order. Let's say at $9.50, what we call a stop loss. What this will do is the order will sleep. It will take no actions at all. You put a stop loss at $9.50. If the shares fall to $9.50, it will attempt to execute the sell of the other 20 shares. So for example, where we start, where the last price was observed was $10.25, no action would be taken. This order would be filed with your broker, but no action would be taken. If somebody else sells, or does a market sale of 11 shares, the price is going to fall to, we've established this before, it's going to fall to 950. Okay. Price last traded share will fall to 950, and what will happen is your stop loss order will wake up. It will switch on, and suddenly your broker will come in and will start to offer more shares. So where available, where before we only had we had a supplier of 10 shares for whatever it was. People were we had buyers trying to buy 10 shares. Suddenly, you still have a buyer trying to buy 10 shares, but there's more supply coming online. Basically, what would happen here is, we had someone, what I said here is we had someone trying to sell 11 shares. So we had someone willing to accept, 11 shares at any price. So we saw 10 trade here, 1 trade there. And as soon as we get down to 950, you click in and you're like, okay, me too. I want to sell all my 20 shares. Now, you may not get all your 20 shares sold at 950. You can see that you won't because there's not enough buying demand. But what will happen is your order will spill over to the lower and lower levels. Okay, and so what the stop loss will do is it basically gets you out of a position. It doesn't necessarily work perfectly, but it will begin to unwind a position if the stock falls below a certain threshold. You will have to accept the fact that some of the shares sold at the end of the stop loss, because it'll be broken up into little chunks. Some of the shares that you sell will perhaps be below the price that you put as your stop loss. So it basically says, get me out of this at 950, but you may find that some of your shares were selling at 930 or $9, or in this case, maybe even $7. Okay. Other qualifiers to orders is you can have what are called a fill or kill, which is basically just telling your broker, I want you to do all of it, or I want you to do none of it. If you can't sell all 20 shares at $9.50, don't sell any of them. It's all on or all off. Why would you do that? I guess because if you have sort of strategic objectives, you may say, look, I'll just wait for the next exit point or something like that. There's the various stories that we could tell why you might do that. But a fill or kill will either be, you tell the broker, if you can't do 100% of it, don't do any of it at all. And then a day order is an order that basically just lasts for the day. When you put a limit order, for example, or a stop loss order, you can say that you would like these orders to stay in force for a couple of days. If you want it to be less than a couple of days, then you can make it a day order, and it'll only last until the end of that day. All right, so I'm going to take a small break here, and we will resume momentarily.